Hello friends, this is Dr. Amarjeet Kaur, Professor of Accounting and Business Communication at the Department of Management, Gurugram University, Gurugram. This is my privilege that I am with you to talk about risk analysis and cash and the capital budgeting decisions. This is the part 2 we are going to resume. In the first part today we talked about risk analysis and capital budgeting, where we discussed two techniques. One was risk adjusted discount rate and another was risk adjusted risk adjustment by using the certainty equivalent approach, CE approach. So today in this half we are going to talk about sensitivity analysis and break-even analysis, another two techniques which are non-statistical but are used for adjusting risk in capital budgeting decision. So friends, as we know that NPV of any project depends upon two important factors. One, the cash flow stream, and the second is discount rate, which is used for discounting these cash flows. So two factors are really important which help us decide the NPV. Now these two factors, which is cash flow and discount rate, are further dependent on many variables. For example, my sales revenue will affect my cash flows, right? If there is a change in sales revenue, my cash flows are going to be affected, because my cash flows are the difference between the sales revenue and the expenses, which is input cost, right? So my sales revenue, my input cost, the competition, these are the factors which will change my cash flows. And so is the market condition. If the market condition is changing positively, I will be able to receive funds at a lower rate. My discount rate would be at a lower level. But if the market is has a different trend, I may have a higher discount rate. So these are the factors which affect the both cash flows and the discount rate as well. So what is sensitivity analysis? As I said, we are going to primarily discuss sensitivity analysis with 1-2 minutes discussion on break-even analysis as well. So sensitivity analysis is if any of the variables which change, which we just discussed, be it sales revenue, be it your input cost, be it competition, then the NPV will also change. It means that NPV is sensitive to all these variables. So however, NPV may not change in the same proportion for all the given variables. So it is not necessary that NPV will change with the same proportion for all the variables, because certain variable could be more sensitive to market condition, to changes happening in the economy, or otherwise other factors may not be equivalent. For example, revenue could be more sensitive to the demand, and which means to the earnings of the people who are consumers, whereas input cost is also dependent on the production. If I am working into the agriculture sector, food sector, etc. So these changes may not be at the same proportion for all the variables. So sensitivity analysis actually deals with consideration of sensitivity of NPV in relation to different variables contributing to NPV. So we call it as SA. So SA is a technique to evaluate the effect of changes in factors contributing to the cash flows on the NPV of the project. So how these factors will contribute to the cash flows on the NPV of the project. This is what is being considered. So in general, SA is theoretical procedure whereby values of the input variables are changed to denote different situations, assumptions, and the effect of these changes is measured on the expected value of the outcome. So this is how the sensitivity analysis is a theoretical procedure, where we are actually changing the input values. So we have X value, we will change the input value, of course the result will be different, right? So we would see how sensitive, my cash flow will be changing by these many percentage, my payback period will be changed by these many days. So we see sensitivity of certain input values to the output. That is how we see. So, there are 4-5 steps which we follow in sensitivity analysis. The first step is to estimate the project cash flows, very explanatory itself. The second step is that we identify variables which have bearing on the cash flows of the project. Third step is establish the relationship between the variables and the input value. Fourth step is that find out the range of variations and the most likely value of each variable. And the last step is that we find out the effect of change in any of these variables on the value of NPV. So, I hope you could get. So, our purpose is to see the sensitivity of input values. Input are, what are the possible inputs? Sales revenue, cost input. In the cost it could be labor cost, material cost, any cost, right? And it could be competition. So, we are basically seeing the sensitivity of input values to the output, to the end result. So, and for that matter we have to have very good experience and understanding to how to identify those variables. If you are good at identifying the variables which can impact my cash flows, your output, your results would be more reliable, more dependent, right. So, it becomes imperative to identify correct or all possible variables which may have bearing on the cash flows of the project. And then we see how they are related, how these variables would affect my cash flows, and then we find out the range of variation and the most likely value for each variable, and that's how we decide about the acceptance or the rejection of the proposal. So, I will be explaining the sensitivity analysis to you with the help of one good case, and we will try to incorporate almost all the possible inputs variables in the discussion. So, this is a case of Yummy's Confectionery, which is evaluating an investment proposal. The proposal requires an investment of rupees 12,000 and has a life of 4 years. It will generate annual cash inflows of 4,500. The required rate of return is 14%. So, analyze the sensitivity of different variables with respect to NPV. So, it says different variables, it does not say X, Y, Z variable. So, you may be given a case in exams, in otherwise you will come across a case situation or a case where even the variables are mentioned, that check the sensitivity of the project to these variables. So, that becomes easy, but in real life any business manager or finance guy would actually need to identify himself or herself that these are the possible variables which may impact my outcome, right. So, getting the point, in reality we have to identify variables, and this case is very much close to real. It is not given to us that see the sensitivity of the cash flows to these variables, rather it says check the sensitivity of different variables with respect to NPV. Okay. So, just remember that the investment proposal is of 12,000, life of 4 years, and the annual cash flows are 4,500. With these 3 numbers, 3 data points, we are going to proceed now. Let us see the sensitivity of the project to initial outflow or outlay. So, for that let us calculate NPV of the project, very simple. I am not discussing NPV calculation again because it has been quite a good number of sessions which we have spent on this topic, and we have calculated NPV in length. So, you shall be able to calculate it quickly. So, we have 4,500 as cash inflow. Since they are in the annuity form, we will go to annuity table, we will find out the factor for 4 years, it is coming out 2.9137. Multiply 4,500 with 2.9137, subtract that value from 12,000, the difference is coming out 1,112, which is a positive NPV, right. This is to begin. Now, I have to see how my NPV changes with certain factors, right. So, this is the beginning point, that you will be calculating NPV with the given data. So, that is the first step we have done. Now, let us see if we change the initial outlay, to what extent this is changeable. Since NPV is 1,112, which means my outlay can increase from 12,000 to 12,000 plus 1,112, which means 13,112 before NPV becomes 0, very simple, right. So, since I have a positive net present value, it means I have a cushion of, I have a margin of 1,112. If I divide this value, which is a margin, with my current outlay of 12,000, it is giving me in percentage 9.4%. So, there is a margin for initial outlay of 9.4%, right. So, that was the first situation. Now, we will discuss about the second situation, how much the project is sensitive with respect to payback period. So, we know how to calculate payback period. We have already spent one session on PB in the past. So, payback period, as we know, the time to recover the cash flows which we are spending, right. How much time would a project take to recover the investment in the simple language. So, the present value factor at 14% is 12,000, right. If we divide it by 4,500, my payback period is coming out 2.667. So, the PB when NPV is 0, the present value factor at 14% is this much. So, from the PV present value factor table, the values which are nearest to 2.26, this is my PB, is at the 14% column, right, which is 2.322. So, right, and 2.914 from 4 years. So, 3 years and so we are getting two values which are close to the PB. 2.667 is our actual PB, right, the current PB. 12,000 is investment divided by cash annual cash inflow inflow 4,500. So, 2.667 was my value of PB. If I go to present value factor table, find out two values nearest to this, because we want to interpolate. So, they are coming out 2.322 for 3 years and 2.914 for 4 years. Therefore, payback period lies between 3 years and 4 years. So, the exact payback period by interpolating between 3 years and 4 years coming out to be 3.58 years. It means the project could fall by 0.42 years before it becomes unviable. The point, the dot is on the previous line, just read it, 0.42 years before it becomes unviable, right. So, it means sensitivity of the project to the payback period is up to or the margin of the time between is 0.42. So, company has to take a call, are they good, because there is not much margin, it is not in years, it is just 0.42 years, less than less than 6 months, right, 0.42 years. So, which is a very less margin. So, company has to see how important it is for them to recover the initial investment, because PB decides the time of recovery of initial investment. If you have a commitment, for example, you have taken a loan for this investment, you have taken a loan from an institution which you are sure cannot give you extension of even 20 days, 30 days or 2 months or 6 months or a year, then this is an important issue for you. But if you think you will be able to pay the interest, you will be able to bargain with the institution who has lent you the loan, and you will be able to delay the payment and without much increase in interest, then you can you should be okay with this difference, right. It all depends how much sensitive your company you are to this particular issue. So, this was the second situation where we are considering the sensitivity of the payback period. Now, there are many more things, as I said, we can take. The third thing we want to discuss is, which is very important actually for anything, that how much sensitive a project is to the cash inflows, because in this case we were not given the input variables to be changed, we decided ourselves. So, what we will do, we will be now looking at the sensitivity of this proposal which is there in the case to the cash inflows. So, the present value factor at 14% for 4 years is 2.9137. Therefore, 12,000 is equal to annual cash inflows into 2.197. So, the annual cash flows comes out to be 4,100 118, right. So, how did we calculate? Just have a look again. We have been given the 4-year N is given, the discount factor is also given. We just found at which, in the table, we just refer to the table and we found that closest to 2.9137 is the present value factor, right. And by multiplying this factor to 12,000, we are getting the annual cash flows of 4,118. Therefore, the annual inflows can decrease from the present level of 4,500 to 4,118, means there is a gap of 382 rupees. Okay. So, and if I calculate this difference, this margin in percentage, 382 divided by 4,500, which is the current cash inflow annual, right. 2.92, the factor also came from the entry table. So, same is here. So my percentage wise margin available for this particular variable is 8.5%, which means what? My cash inflows can decline to by 8.5% before the project becomes unviable, before I end up into losses. It means there is a good margin of 8.5%. But nevertheless, you have to see as a company, how, because any variable could be important for one company, could be less important for other company. So, because every single factor, be it cash inflow, be it cost of output inputs, be it competition, could be different. Even within the same company, these factors would have different bearing on different projects or different products. One product could be more sensitive to competition, another could be less sensitive, because that is a niche product or market for you. Same is, one project could be more sensitive to time period than the other, because depending on the funding, who was the funding agency for the project. So, the funding agency which is behind the project will actually be having its terms and condition peculiar to the project, because the funding agencies decide the conditions, terms and conditions, covenants, etc. for every individual project. Even for the same company, for two different projects, these conditions, these covenants could be different. So, it becomes very important to calculate sensitivity of every project independently, even within the same company. And of course, every variable is different for the same project even. Okay, so, every variable would have a different rate of sensitivity. You have seen, previous factors were, one factor was 9 point something in percentage. This factor, which is cash flows, is 8.5% in in percentage as sensitive to the project. So, we have, this is how we consider. So, next point I want to discuss is sensitivity of the proposal with respect to discount rate. So, let us say the discount rate at which the NPV is 0 is x, we are assuming to calculate this. So, therefore, 12,000 is equal to 4,500, which is the annual cash inflow, multiplied by x. So, x becomes, if I divide 12,000 with 4,500, it becomes x. So, we can calculate the value of x, which we assumed, which is coming out to be 2.667. So, the present value annuity factor of 2.667 for 4 years is approximately found at 18% column of present value annuity table. So, what did we do? We went to present value annuity table, right, and we referred to the row and the column corresponding like 4 years, and where the factor is 2.667. So, it is coming out to be, if you look at the column, it is coming out at 18% for 4 years. So, the row which we will refer would be year, right, the year is n, in this case is 4. So, refer to the table 4 years, 4 year, the row for 4th year, and then stop where the value is close to 2.667, and then go upward, then go towards the column at the top, and then you will find the rate at which this 2.667 is coming is 18%, right. So, therefore, the rate can increase from 14 to 18% before NPV becomes negative or unviable. So, to conclude, it can be said that project is most sensitive to annual cash inflow, and even a change of 8% can make it unviable. So, friends, we have discounted cash flows with the help of 14% rate given, and we have used 4,500 the cash inflows which were in the form of annuity, and then the whole project was for 4 years and was 12,000 was the cash outflow. This was the data. So, what we have done, we have seen the sensitivity of the project to the cash flows, to the discount factor, payback period, to the change in terms of couple of more things like this discount rate, with respect to even the payback period, even with respect to the first thing was the initial outlay, how much can we be spending more, how much we can, because there is a possibility that outlay could go higher, right. So, what is the possibility that outlay can exceed 12,000 and you do not lose money, you do not end up in losses, is not much, right. That was 1,112. Then sensitivity to cash inflows, sensitivity to payback period, sensitivity to cash inflow was 8.5%, right, the last thing which we discussed. So, all these things have been discussed, and we found, and now company has to take a call, because even in this calculation any particular project, any particular variable could have higher bearing, could have higher sensitivity, but that factor, though as per the calculation is having higher sensitivity to the project, but that factor may actually not be much important to the company, because company could be very sure about that factor in future. So, and company may have other reasons to decide or ignore that factor. So, so it means we have to use a pragmatic approach along with the calculation part. The pragmatic approach is based on, of course, the experience of the person, of the finance person or the management who are using this technique, but nevertheless this is a very good technique where we are able to see the sensitivity of many variables and being able to decide well. Okay. So, therefore, the rate can increase from 14% in this case to 18% even, because that was the last thing we concluded, and we can say that company is more sensitive to the 8.4% cash inflows. Now, the last technique I want to talk is break even analysis. So, what is break even point or break even analysis? The break even point is something which defines that when an investment will generate a positive return, means all the, so we generally use break even analysis in management accounting, not in finance, but today we are discussing the same technique for financial purpose. In break even analysis actually decides when the investment will generate positive return, means the cost is recovered. So, break even analysis volume of the production at a given price necessary to cover all the cost. So, break even analysis computes the value of the production, right. This is what the break even analysis is. So, volume of production at a given price necessary to cover all the cost is discussed, is found, and when all the costs are recovered, our output would be positive, we will have a positive play, right. So, it actually helps businesses understand how many units they need to sell to cover their cost, which is crucial for making informed decision, of course, because about pricing, about production, about capital investment. So, these are the points which are considered in break-even analysis. So, break-even point in unit is actually the fixed cost divided by the difference of selling price and variable cost, which we call as contribution margin. So, that gives you that these many units must be sold to calculate the break-even point. So, this break-even point can be calculated in rupees, this can be calculated in units. So, both way it helps companies to decide that company shall be able to make profits after it is able to reach X level of sales, right, or Y level of sales. Beyond that point, the company is going to make margins, profits. So, this is break-even analysis is a very commonly used technique, because in break-even analysis we are considering, we can actually consider different sales level and calculate multiple break-even points, right. It means by considering X level of sales, I will have one point of break-even. By considering Y level of sales, I will have a different break-even point, right. And then company can see which is the more realistic point of sales for the company. So, it means this gives us a flexibility to calculate break-even point at different sales volume. And break-even point has three major things. As we saw, we have variable cost, we have fixed cost, we have selling price. These are the three variables which really affects your break-even point calculation. So, fixed cost is something which remains fixed for the company. So, selling price and the variable cost are the two important things which finally affects the break-even calculation. This was the fourth technique of the non-statistical methods we discussed. Overall, these four techniques of risk analysis or risk consideration or risk incorporation into net present value, they all help us calculate the risk adjusted net present value, and also help us that should the project be accepted or not. So, sensitivity analysis is something where many factors can be incorporated, and break-even point is where we have limited factors which are incorporated. On the other hand, the previous two factors, previous two methods, certainty equivalent factor and the discount factor are very direct method of incorporating risk into the analysis and calculating net present value. So, I believe I was able to help you understand these two important techniques. This is the time to wind up, friends. I would like to wind up now. Thank you. See you in future. Thank you.